three charts that spell trouble for stocks. Sergio, you're a fearmonger. You are calling for the end of the world. No, I'm not. Some people are thinking that right now when they watch this video, or they just, usually those kind of people will just read basically the subject line of the video. If you've been following me for longer than a cup of coffee, you know that I like to look at the stock market as basically opportunities on both sides of the market, very neutral. In other words, I like to look at the potential reward to the upside and the risk of the downside, and vice versa. So I am going to show you three charts right now, but also note that just to kind of back this up away from just charts, this is very sunny here today. I do want to quickly point out the fact that if you look at earnings, U.S. corporate earnings, I think we're about 40–50% through the earnings season right now of Q4 2018. And earnings growth rates has actually been slowing quite a bit from like 20–25% last year to now maybe 12%. So companies are still making good money, but they're growing less good, if you will. So that's one thing. And let me just show you a couple of charts. So, all right. First of all, what we're looking at here, have a look at this. This is the S&P 500. I believe the S&P is the blue line. Then you have gold and treasuries, and everything's basically rallied straight off since late December. That's usually doesn't happen a whole lot. My bet is that equities here are probably capped for the time being. But there are two particular charts I'm going to show you right now real quick, and those two charts are what I, to clients, always call sort of broader risk on, risk off measurements. And one of them is high yield. We look at the HYG ETF, and the other one is broker-dealer stocks, XBD, I believe is the ETF. So I'm going to show you this real quick, and usually what happens is, depending on how these kind of parts of the market act, stocks will either do well or not well, whether, you know, in relation to that. So let's have a look at this real quick. And the first chart here, we're going to start off with the XBD. This is broker-dealers, okay? And if you look at, we're going to keep this very, very simple, but I think it does prove the point. If you look at this red line, that's the 200-day moving average, and you can see when we break above it, it tends to hold as support. When we break below it, it keeps resistance. Right now, we're getting closer and closer. We're not quite there yet, but we're getting closer and closer to potentially fighting it as resistance once again. So that's one chart. The other chart, real quick, is that of high yield, HYG. And this looks very, very similar. So you can see here the red line when the ETF or high yield bonds break. I hurt my finger over the weekend. When it breaks above the 200-day, it's good, and otherwise it finds resistance. And right now we're right up at this resistance level. Can we break above it? Listen, everything's possible, but I think economic gravity at this point here isn't very supportive of that potential move. Also, look at the very sharp rally we had just now into this area. I think there's a lot of resistance here at the 200-day, and if you go back in time, you can see how well that's acted as support and resistance. So just keep that in mind. So I'm going to quickly point this out, folks. You know, when you look at the market through a top-down lens like we do here at the Steady Trader and Blue Oak Advisors, you over time learn to respect some very key factors, and you learn to look at the market basically through a lens of global risk assets. So here we're looking at broker-dealers, which are, some of these are very, very big companies like Morgan Stanley, which with global exposure. We're looking at high-yield bonds, which is also fairly a smart money kind of indicator. So that kind of approach has served us very well over the years, and I'm here to share that with you, and I certainly share this with paying clients on a daily basis. So those are my, I guess, three stocks that do kind of cast a fairly big shadow over stocks for me. This is not the call for the end of the world. This is just to look at the market through the lens of global assets and kind of be a little bit more realistic as where we are, particularly after a strong move we just had in January 2019. So I hope this helps, folks, and I'll see you guys tomorrow.